Hello all, welcome you to the course on corporate laws and governance. In this video, we are going to look at corporate governance rating. Let's understand what corporate governance rating all about. Corporate governance rating is a score which indicates the risk profile of a company, and this rating would be given by an independent credible rating agency. So, it is an opinion on the corporate governance practices of a company. So, the investors and the stakeholders will get to know how good the corporate governance practices of a company through this corporate governance rating. And is it compulsory? It is definitely not compulsory. In India, if a company wants to go for corporate governance rating, it is very much voluntary in nature. It is not mandatory. CRISIL, that is Credit Rating Information Services India Limited, was the first agency to introduce the corporate governance rating in India. It was followed by ICRA, CARE and other agencies into this credit rating process. If we look at the world scenario, there are many international institutions which are into corporate governance rating. To name a few, we have Institutional Shareholders Services, MSCI ESG rating, the Corporate Library, as well as Standard & Poor. Let's look at the assessment criteria for the corporate governance rating. Not that every company will have the same criteria for assessment of the corporate governance that are adopted by a company. The assessment criteria varies from one agency to another agency. The methodology definitely varies from one agency to another agency. Still, there are certain parameters which are pretty common across the rating agency. Let's look at what are all the common parameters by and large most of the companies follow while performing this corporate governance rating. They are the board and management effectiveness, where the rating agency would be looking at the financial performance, operational performance, how good the audit is, both internal as well as the external audit, how independent the independent directors are, and they will be checking the performance of different committees, like we do have the nomination and remuneration committee, stakeholders committee. So there are different committees, so their performance would be evaluated. Even the rating agency would be looking at the internal control system that is in place in a particular company. They will be checking the risk management procedure, framework that the company has. All these would be evaluated. So by and large, most of the rating agencies look at the board and the management effectiveness, wherein both operational and financial performance is evaluated. They also look at how transparent these companies are in divulging the details. When we say the details, it includes both financial as well as non-financial information. Non-financial information, we talk about sustainability, environment, governance norms, etc. So they look at the quality of the transparency of both financial and non-financial information by the company. They also check the related party transactions, whether the independent directors are really independent. So they will check whether the independent directors are free from any kind of material relationship, either with the board or with the management or with a subsidiary company. So this would be checked in the related party transactions. They also look at the ownership structure. Ownership structure could be a diffused ownership structure, or it could be a concentrated ownership structure. Whatever be the structure that the company follows, they would check like what kind of structure that the company follows. If it is going to be a concentrated ownership structure, they'll check whether the minority shareholders' rights are protected. If it is going to be a diffused ownership structure, they will check whether there are any agency problems, how good the management is in protecting the interest of the shareholders. All these would be checked depending on the ownership structure that the company follows. They will also check how the company is not only in managing the shareholders relationship, but also in managing the relationship with other stakeholders like the customers, employees, public, suppliers and so on. They will also check whether the company follows all the statutory regulations which they are supposed to follow. The compliance would be checked by the corporate governance rating agency. So these are all some of the criteria which are by and large covered by most of the corporate governance rating agencies while assessing the performance of the companies with respect to the corporate governance practices. Now let's look at the things which are very, very important to be noted with respect to the corporate governance rating. One should know that just because a company gets the corporate governance rating, let's assume they get a very good rating in corporate governance rating, it doesn't mean that it is a certificate that they have complied with all the statutory regulation. It is an independent agency which actually performs this corporate governance rating. So it is not a certificate for the company that they have complied with all the statutory regulations which they are supposed to follow with respect to corporate governance. And one cannot make an assumption that the quality of the debt instruments that are issued by the company are determined by the corporate governance rating. Just because a company is going to have a very good corporate governance rating, one cannot make an assumption that the debt instruments that are issued by the company are of very high quality. That assumption can never ever be made. There is no relationship between the quality of the debt instruments and the corporate governance rating which the company gets from independent agencies. And the corporate governance rating is not a recommendation to the investors whether they should go for purchasing the shares of a particular company or sell it based on the corporate governance rating. It is an indicative of the risk assessment of a particular company by an independent rating agency. It is an opinion on the corporate governance practices of a particular company. So it is not a recommendation by the agencies through the corporate governance rating whether an investor should buy or sell the stocks, whether the investor should decide the quality of the debt instruments based on the corporate governance rating. So all these should not be construed by the investors looking at the corporate governance rating. Let's look at the assessment criteria which CRISIL follows in their governance and value creation grading. So we know like CRISIL was the first credit rating agency to introduce the corporate governance rating. So let's look at what are all the assessment criteria that CRISIL follows while giving the corporate governance rating. Let's look at the parameters that they actually look at while assessing the corporate governance rating. One parameter that they look at is the corporate governance, under which they look at the board performance, ownership concentration, shareholders relations, disclosure and financial statements. They look at the management performance, they evaluate the management performance, which we call it as management evaluation, wherein management is getting evaluated for its credibility, for its performance, the kind of innovation that it brings in the operation, and the kind of risk management framework that the company has, how effective they are in decision making, how independent they are in their decision making. All these are checked under management evaluation. Under value creation, the CRISIL looks at the values that are created for not only the shareholders but also for the debt holders, customers, suppliers, employees, etc. See, they look at the value creation for all the stakeholders. The next assessment criteria is the environmental profile, where the company would be assessed for its greenhouse gas emissions, the kind of energy that it uses, whether they use renewable energy sources or non-renewable energy sources, what is the ratio of renewable and non-renewable energy source that it uses, how does it manage its waste, both the toxic waste as well as the non-toxic waste, the kind of policies that they have with respect to the pollution control, and how effectively they use the water, especially in those areas where the scarcity of water is very, very high, and how effectively they use their land. All these are looked at under the environmental profile. And when we look at the social profile, the company would be assessed for its workforce. When we say workforce, we talk about both the temporary as well as the permanent workforce, the kind of compensation that the company has for its temporary and the permanent workforce, how diversified the workforce is. When we say diversity, diversity in terms of gender, in terms of physically challenged individuals, in terms of socially underprivileged sections of the society who are there in the workforce, and what kind of policies that the company has for these physically challenged, socially disadvantaged sections of the society, and what kind of environment that the company gives to the workforce. When we talk about the environment, we talk about the health and safety that are given to the workforce, and the kind of grievance redressal system that they have for their customers. So how effectively they engage with their customers, what kind of initiatives that they take for the community, wherein we talk about the social impact assessment, rehabilitation and resettlement. So all these community development programs which the company takes up, all these would be checked under the social profile. So these are all the different parameters which the CRISIL uses while evaluating the corporate governance of a company. Next, let's look at the methodology which the company, which CRISIL follows while giving the corporate governance rating. First, what they do is they go for a desk research. What is this desk research all about? Here they collect information about the company from the public domain, like they look at the balance sheet, financial statement, they look at the cash flow statement, they also look for different types of statements, the sustainability reports. So whatever reports that are available, both financial and non-financial information, all these would be accessed by the company in order to give the rating. So the first step is they go for a desk research, wherein they look at the financial statements, wherein they look at the balance sheet, cash flow statements, they look at the sustainability reports and other such reports which are available in the public domain in order to assess the corporate governance performance of a particular company. Not only that, what do? They look for the different types of documentations that happens within the company, wherein they collect the transcripts and the minutes of the board meetings that happens in the company. So they look at the terms and conditions that they have for the suppliers, the different policies that they have for the employees, they evaluate the management profiles. All these are done under the data analysis stage. Then they not only that, along with desk research and data analysis, they also conduct in-depth personal interviews with the board members, senior management, employees, customers, etc., wherein they check with these stakeholders about the business highlights, lapses that has happened, what are all the opportunities that are there for the company. So they look at the risk profile of the company. So all these and the corporate governance process which the company follows, all these are checked through the in-depth structured personal interview with the different stakeholders like the board members, senior management, employees, customers, etc. After doing the desk research, data analysis and the detailed discussion, what the company does, what CRISIL does is the CRISIL goes for giving the score. So here when they do these analysis, some would be quantitative in nature, some would be qualitative in nature. Whether it is qualitative or quantitative, whenever they assess the performance and assign the score, they will come with a rationale. That is the reason why they give different scores for different criteria. They will have to give valid reasons for assigning different scores for different criteria, whether it is going to be qualitative or quantitative. So scoring happens in the next stage. After the scoring is being done, whatever scoring that had been done by the evaluation committee, it would be reviewed by the review committee, which consists of the top officials of CRISIL, where they would be looking at the validity of and the veracity of all the gradings and the scorings that had been given to the company on various assessment criteria and parameters. Once the committee is happy with the grading, what do is they actually publish it in the public domain. But this publishing of the corporate governance rating of a company would be done by CRISIL only after getting the consent from the company for which they have carried out this corporate governance rating. So the company would be reviewing it, and they will be, once the company is okay with the grading, once they give the consent to CRISIL to publish the corporate governance rating of the company in the public domain, then only it would be published in the public domain. So these are all the methodology that the CRISIL follows in the corporate governance and rating of the companies. So these are all the different grades that CRISIL gives. Grade ranges from 1 to 8. If a company gets a grade of 1, that means they are the benchmark for other companies with respect to corporate governance. They are very highly transparent, they have excellent sustainability practices, and they are the leaders in the stakeholders value creation, and they have a very strong management. If a particular company is going to get the grade 4, that means they fall under average, wherein if you look at their performance, they have only adequate comfort with respect to the corporate governance practices, they have only moderate transparency, they have good sustainability practices, and they have average stakeholder value creation. And if you look at the management, it is moderately strong. In case a company is going to get a grade of 8, that means they are very weak with respect to corporate governance, they are very poor with they have a very poor comfort in the corporate governance practices, and they completely lack transparency in their operations, in their financial and non-financial information, and they do not have any focus in their sustainability, and they have a negative stakeholders value creation, and their management is highly incompetent. So the grading, there are different gradings starting from excellent, very good, good, average, below average, weak, as well as very weak. So this will help the investors to know where the company stands with respect to corporate governance practices. Let's look at one more rating agency that we have, which is the Corporate Governance Scorecard that was developed by the Bombay Stock Exchange with the International Financial Corporation. So BSE, the Bombay Stock Exchange, has come out with the Corporate Governance Scorecard for the companies by collaborating with the International Finance Corporation, Washington. And they have roped in institutional investor advisory services in order to devise the questionnaire which will help in assessing the corporate governance practices of the company. If you look at this corporate governance scorecard, which the Institutional Investors Advisory Services has developed, it is based on the 4 OECD principles. This OECD principles is the Organization for Economic Cooperation and Development. They have come out with the principles of corporate governance. The 4 principles of OECD's for corporate governance has been taken as the basis for developing the questionnaire. Let's look at what are all the 4 principles based on which the questionnaire was developed by Institutional Investor Advisory Services. One is enforcing rights and equitable treatment of shareholders. Another principle is the role of stakeholders. The third one is the disclosure and transparency. And the fourth one is the responsibilities of the board. These are all the 4 principles of OECD which had become the basis for developing the instrument by IIAS to evaluate the corporate governance performance of the companies. Let's see how the evaluation method is for this Bombay Stock Exchange initiative for the corporate governance scorecard of companies. So if you look at it, the quality of the corporate governance practices are recognized at 3 levels. every question they have different questions under each of the category, and for each of the questions can be graded into 3 levels. So a question can get 2 points, or it can get 1 point or 0 points. If a question gets 2 points, what it means is the company follows the best practices for that particular element of corporate governance. It is on par with the international quality standards. So if a company is going to get a grading of 2 for a particular question in the questionnaire, what it means is they are the best as per the international standards with respect to the corporate governance, with respect to that particular element of the corporate governance. If they are going to get 1 point, that means they have reasonable practices, or at least they meet the Indian standards, if not the international standards, for that particular element of corporate governance. If they are going to get 0 points, what it means is they have to improve in that particular element of corporate governance. So each question in the questionnaire carries 3 marks. One can get 2 marks, 1 mark or 0 mark, 2 is the best, 0 is the worst. 2 means that the company follows the corporate governance practices as per the international standards. If they are going to get 1, that means they are following it as per the Indian standards, or if they are going to get 0, that means they will have to improve on that particular element. Let's see the weightage that they have for different categories. We have already seen that this particular questionnaire has 4 broad categories based on OECD's principles on corporate governance. So one is the rights and equitable treatment of shareholders, another is role of stakeholders, third one is disclosure and transparency, and the fourth one is responsibilities of the board. If you look at it, all except role of stakeholders, the rest of the 3 categories have equal weightage, and the weightage is 30%. So 30% of weightage is given to the rest of the 3 categories, and the role of stakeholders carries a weightage of 10%. Next, let's look at the ESG rating of MSCI. It is an international organization which is involved in corporate governance rating for companies across globe, and they do the rating based on the environment, sustainability and governance. If you look at MSCI is a global leading investment research firm. They are into different financial markets like the mutual funds, equity, exchange traded funds, derivatives. So they are into different types of financial markets. One of the services which MSCI offers is the evaluating the companies based on the environment, social and governance performance. So this will help the company, this ESG rating by MSCI will help the company in knowing where they stand with respect to the environment, social and governance, risk exposure and risk management. So they will get to know about their position if they go for this ESG rating. If we look at this MSCI's rating system, here they are giving different types of rating starting from AAA to CCC. So we have 3 categories, AAA and AA. If a particular company is going to get an ESG rating of AAA and AA, that means they are considered to be the leaders with respect to the risk and opportunity exposure with for the environment, social and governance. If a company is going to get a rating of A, BBB and B, that means they are considered to be average in their risk exposure and management with respect to environment, social and governance, if a company is going to get a rating of B or triple C, that means they are lagging in their ESG in comparison with other companies. We do have different scoring system. So basically there are three categories. Let's look at the methodology which ESG scoring is done by MSCI. So we can see there are three important categories which MSCI looks at. One is the environmental pillar, another is social pillar, and the third one is the governance pillar. We do have boxes with dotted outline. What it means is these dotted boxes are specific to a particular industry. Not all industry would be assessed on these categories like product, carbon footprint, biodiversity and land usage, health and safety, product safety and quality, opportunities in nutrition and health. See, these are not specific to all the industries. These are all specific to certain industries. For instance, if you look at soft drinks industry, so all these soft drinks industry should be evaluated for their health and safety, for the kind of with respect to the nutrition and health. They have to be evaluated on their packaging material and waste, because it is there is a vulnerability with respect to the water pollution and the land, the pollution that happens in the land. Similarly, the kind of carbon footprints that they leave through their products. So this is specific to a particular industry. So these parameters differ based on the kind of industry that the company belongs to. So, but by and large, if you look at it, those boxes in green line would be there for all the companies irrespective of the industry, where we talk about the climate change, natural capital, pollution, and water, environmental opportunities and environment under environmental pillar. We have human capital, product liability, stakeholders opposition, social opportunities under social pillar, and under governance pillar we have corporate governance and the corporate behavior. There under these categories the parameters may vary. Some parameters are constant for all the companies across industries, but there are some parameters which MSCI includes depending on the industry to which a particular company belongs to. So when we look at this governance pillar, we do have pink boxes. So this performance is specific to a particular company, how good they are in their board management, their board performance, the kind of pay, remuneration that they fix for the top management, the ownership structure that they have, as well as whether they follow the accounting standards. All these are specific to a particular company. Similarly, how transparent they are with respect to their taxes and how ethical they are in their business operations. These are all pretty specific to a company. And the other, when we look at environment and social, where industry also comes into the play, the company, the industry to which the company belongs to defines, to some extent it defines their environmental performance as well as the social performance. So these are all the methodology that MSCI follows with respect to environment, social and governance. Next, let's look at the benefits of corporate governance rating. Corporate governance rating is definitely beneficial to all the companies that get rated by the independent agencies. It is not mandatory in India, it is pretty voluntary. But when a company goes for the corporate governance rating, it helps the company in many ways. One advantage that the company has is that it is easy for them to raise funds, especially from the international market, because the international investors are very, very particular with respect to the quality of the company. So it would be easy for them to make a decision to make their investment in those companies which have gone for corporate governance governance rating, and to those companies which have got a very good score under the corporate governance rating. So it becomes easy for the companies who get rated on their corporate governance to raise money from the not only within the country but also from the international market. When a company is going to have a very good rating in the corporate governance, automatically they get very good valuation. Whenever the firm is valued what happens? The cost of raising capital comes down drastically. People would be ready to buy, ready to invest in those companies. So the cost with which the money is raised also comes down drastically for the company. Next is that it would be easy for the company with good rating in corporate governance with the third parties. When we say third parties, we mean the employees, the suppliers, distributors, customers, etc. So there would be credibility, and since there is credibility which comes with this corporate governance rating, these stakeholders would be willing to have association with the company. So it becomes easy for the company to deal with these third parties. When a company goes for corporate governance rating, their governance improves. The reason being, they know that they will have to show better performance each time as they go for the corporate governance rating. So it puts a pressure on them that they will have to adhere to the rules. They will have to be ethical in their operation. So they have to follow ethics, they have to follow the legalities, and they also should ensure that whatever activities that they do, that it results in value creation both for the shareholders as well as for the stakeholders. So it creates a kind of pressure on the companies to perform better and better in order to get better rating, which will help them in raising money easy, which helps them in getting better valuation, and which helps them in dealing with the third parties easily. So the next important benefit of the corporate governance rating for the company is that they have to create value for all the stakeholders, not only for the shareholders. So value creation should be balanced. So among the employees, customers, suppliers, distributors, etc. So somewhere down the line, they ensure that there is wealth creation, and this wealth creation is distributed equally among the shareholders, among all the stakeholders. Next, let's look at what are the benefits that corporate governance rating gives to the stakeholders. The first benefit which the stakeholders get is that they can easily compare one company from that of the other based on the corporate governance rating. So it is easy for them to choose which company they want to associate with based on the corporate governance score that the company has. Next is that somewhere down the line, stakeholders have the responsibility of ensuring that the board is taking care of the welfare of all the stakeholders. So through this corporate governance rating, they will know whether the board of directors are doing their duty well or not, because one of the parameters that are used in the corporate governance rating is the board performance. Board evaluation happens. So they will know how the board performs through the corporate governance rating, and they can have a close watch on the performance of the board of directors through the corporate governance rating. And they will also know how good the internal control system in the particular company, what kind of risk management mechanism that the company has in place, how good the auditing quality is there in a particular company. All these can be understood very well by the stakeholders. And in case the company is not up to the mark, it is an opportunity for the stakeholders to push these companies to improve their corporate governance performance, because the corporate governance rating will definitely give an idea like where they are, if a particular company is going to lag in their corporate governance performance. It is an opportunity for the stakeholders to ensure that the company works towards the better corporate governance practices. So these are all the benefits. Thanks for listening.